Condo owners are still dealing with rising homeowner association fees and insurance premiums. According to Realtor.com, the average sales price for a condo is down from last year.
The Florida Realtors Trade Association lists upholding condominium safety and affordability as one of its 2026 legislative priorities.
Something strange is happening in neighborhoods all over America. For sale signs are multiplying, listings are piling up, and a lot of the people putting their property on the market right now aren't desperate families forced to move. They're the investors, the landlords, the people who are supposed to know this game better than anyone, and they are quietly heading for the exits all at the same time. So the question on everybody's mind is the obvious one. If the smart money is dumping property right now, do they know something we don't? Is this the start of another 2008? Today, I'm going to show you exactly who's selling, the real reasons behind it, and most importantly, what's actually coming next. And I promise you, the answer is not what the panic merchants are screaming. If you want help putting all this into action in your own situation, grab our 2026 Housing Survival Guide. It's a simple, easy-to-follow playbook showing you how to protect your home equity, avoid costly mistakes, spot crash risk markets, and find hidden real estate opportunities. The average reader could save or avoid losing thousands of dollars by making smarter decisions. The link is in the description. Let me start by separating fact from fear, because both are flying around right now. Here's what's genuinely true. The supply of homes for sale has been climbing steadily, and in much of the country, the balance of power has tilted away from sellers and toward buyers for the first time in years. Price cuts have become common. More sellers are having to reduce asking prices to attract buyers, especially in markets where supply has grown faster.
Price cuts. 92% of agents in Q4 had at least one seller cut the price versus 89% in the previous quarter. And in fact, nearly half of the agents said the majority of their sellers cut prices. Of course, cutting prices is not high on a seller's wish list, so we did see more agents with delistings. 51% reported having to pull at least one home off the market, compared with 40% in Q3.
By the spring of 2026, the market had strung together month after month, where typical asking prices were actually lower than they'd been a year earlier. In the markets that ran hottest during the pandemic, sellers have lost their leverage and are slashing prices to get deals done. So no, you're not imagining it. There really is a wave of property hitting the market and a real softening in a lot of places. But here's where the fear gets ahead of the facts. The word everyone reaches for is dumping, and it conjures up images of panic, of a market in free fall of 2008 all over again. The reality is more specific and more interesting than that. It's not that literally everyone is selling. It's that several very particular groups of sellers have all decided to move at roughly the same moment for reasons that are completely rational, and when they pile up together, it looks like a stampede. So let me walk you through exactly who these sellers are, one wave at a time, because understanding who's selling tells you everything about what happens next. And the third wave is the one almost nobody is talking about. And the first wave, and the most important one, is the professional investors, the big money. For years, large investors treated American housing like a money printing machine. With rock-bottom interest rates and rising rents, they bought up enormous numbers of homes and turned them into rentals. But that machine has now thrown itself into reverse. The largest investors have flipped from being net buyers to net sellers, meaning they're now selling more homes than they're buying.
Proposal, and it is just that, by President Trump to limit the ability of investors like yourselves to buy into the single-family housing market here in the United States.
Yeah, I think that the headlines from yesterday were definitely eye-catching for us. The big point is that there is an affordability crisis within the housing sector within the U.S., and it's not just a U.S. phenomenon. This is a global phenomenon. The headlines from yesterday were particularly going after a group of investors, institutional investors, call that any investor that owns more than 100 units.
Institutional purchases of single-family homes have collapsed by more than 90% since their peak. In every major housing market in the country, these investors now make up a bigger share of the homes being listed for sale than their share of homes actually owned. In plain English, they are heading for the door faster than their footprint would suggest. Why? Because the math that made housing irresistible to them stopped working. Rents flattened out and stopped climbing the way they used to, so the monthly income dried up. Meanwhile, the price they could get by simply selling started to look better than the rent they could collect. When you can grab a pile of cash today versus squeezing out a thinning stream of rent for years, in a market that feels volatile, a lot of these firms decided to take the money and reduce their risk. This isn't panic, it's cold, professional calculation. And when the coldest, most calculating money in the business decides to sell, it naturally makes everyone else nervous. And it's worth knowing where they're going because it reveals their thinking. A lot of these firms aren't abandoning rentals at all. They're pivoting to what's called build to rent, pouring money into purpose-built rental neighborhoods instead. So when you see them listing those existing houses, you're not watching them flee housing. You're watching them reposition, dumping the assets that no longer fit their model.
Well, President Trump has proposed banning institutional investors from buying single-family homes. That's as a way to address affordability. Is this a meaningful solution?
Well, it's always nice to see attention being paid to the housing affordability issue. It is a key issue in this country. Institutional investors make up a small share of home buying in the United States. I think a sustainable solution to solving the housing crisis is a supply-side solution.
In some markets, the reversal is staggering. In Atlanta, for example, investors have been selling close to 2 homes for every one they buy. That's not trimming around the edges. That's a full-on rotation out of a market they once dominated. And it's the clearest signal of how decisively the professional money has changed its mind. The second wave is the Sun Belt seller, and this is where the price cutting is most brutal. Think about the places that went absolutely vertical during the pandemic. The boom towns of Texas and Florida, cities like Austin, Tampa, and the broader Sun Belt, where prices exploded as remote workers and investors flooded in. Those same markets are now the epicenter of the correction. As of 2026, sellers in Texas and Florida have been the most likely in the entire country to cut their asking prices. These are the markets where inventory has grown fastest and sellers have lost leverage. The homeowner who bought near the peak in one of these cities is now watching neighbors slash prices around them, and many are rushing to sell before the number drops any further. It becomes self-reinforcing. Falling prices trigger more selling, which pushes prices down further, which triggers more selling.
For example, in Atlanta, 1 in 10 homes, roughly 10.7% homes that were listed for sale in April were pulled off the market. Atlanta is currently a strong buyer's market, meaning buyers have the upper hand and sellers there simply could not get the prices they wanted.
The irony is that the very cities people were desperate to buy into 3 years ago, paying over asking and waiving inspections, are now the cities where sellers are most anxious to get out. The boomtown and the bus town turned out to be the same place, just 2 years apart. And then there's the third wave, the one that's quietly bleeding owners out of the market, and almost no headline mentions it. This wave isn't about greed or speculation. It's about the simple, crushing cost of holding on to a property. We've talked before about the insurance crisis, and it's central here. In the hardest hit states, the cost of insuring a home has climbed to several times the national average, and property taxes have crept up right alongside it. For a lot of owners, especially in coastal and Sunbelt markets, the cost of simply keeping a home has quietly outrun what they can afford. Some are people who own outright with no mortgage, being forced to sell purely because they can no longer carry the insurance bill. Others are investors whose rental turned from profitable to money losing the moment that insurance premium doubled.
Average of about $405 to about $500 a year or annually for condo insurance, which actually has increased to about $900 to just over $1,000 a year. In some sectors, in some areas, especially South Florida, you're seeing upwards of $5,000 to $10,000 a year.
This is a silent eviction, not of renters, but of owners, pushed out by carrying costs they never saw coming. And every one of them adds another home to the pile. There's a quieter fourth force feeding the supply too, and it's the slow thaw of the frozen market. For years, millions of owners sat locked into mortgages near 3%, refusing to sell because trading up to today's rates felt insane. That lock-in kept supply artificially low, but life doesn't wait for interest rates. People still divorce, relocate for jobs, retire, downsize, and pass away. Every month, a steady trickle of those locked-in owners is forced to sell no matter how much they hate the rate they're walking into. The dam doesn't break all at once. It leaks, And as that trickle joins the 3 bigger waves, the total supply on the market keeps climbing, which is exactly why it suddenly feels like everyone is selling. So now you've got these waves crashing onto the market at once.
So sellers face a brutal choice: cut your price or delist. The third reason is related to the pandemic, something which is over, but the price hangover still persists. A fundamental mismatch has been created due to pandemic-era prices when homeowners saw their property prices double in value in just 2 years. Those sellers still have that number in their heads. They want the top of the market price.
Professional investors cashing out, Sunbelt sellers racing to beat the price drops, owners squeezed out by the cost of holding, and the locked-in finally trickling free. Stack them together, and you get exactly what it looks like from the street: a flood of property, a market that feels like it's being dumped. Which brings us to the question you actually clicked on. Is this 2008? Is the crash finally here? And here, I need you to stop and pay close attention, because this is where almost everyone gets it dangerously wrong. No, this is not 2008, and the people telling you a catastrophic crash is coming are either uninformed or selling you fear for clicks. Let me give you the cold, hard reasons why, because they matter for every decision you're about to make. In 2008, the market collapsed because it was rotten from the inside. Lenders were handing out mortgages to anyone with a pulse, with no down payment, no proof of income, and ticking time bomb loan terms. When prices wobbled, millions of people who never should have qualified defaulted all at once, and the whole thing came crashing down. Today's market is the opposite in almost every way that matters. Lending standards have been strict for years, so the people who own homes today actually qualified for them and can afford their payments. Most homeowners are sitting on a mountain of equity built up over years of rising prices, which is a cushion, not a cliff. A huge share are locked into cheap mortgages from years ago and have zero reason to default or fire sale their home. And here's the biggest difference of all. In 2008, the country had way too many homes. Today, the United States is structurally short millions of homes. We did not build enough for over a decade, and that shortage is the floor under the entire market. You cannot have a 2008-style collapse when the fundamental problem is too few homes, not too many.
In the United States, I think a sustainable solution to solving the housing crisis is a supply-side solution. We need to build more homes, make it easier, more affordable to build more homes in this country.
So finally, Odetta, do you see any relief on that supply constraint?
Well, if builders have been slowing production recently, but I think as the rate lock-in effect loosens a bit at the margin, we could see existing homeowners make the decision to put their home on the market, which should allow some more inventory to enter the market. We are entering 2026 with higher levels of active inventory than a year ago, and that's certainly another bright spot in the housing market as we enter this new year.
So while it feels like a flood, the foundation underneath is nothing like the rotten ground of the last crash. Hold on to that, because it's the key to understanding what comes next. Think about the mechanics of what actually made 2008 a catastrophe. It wasn't just that prices fell, it was that falling prices triggered a tidal wave of forced selling. People owed more than their homes were worth, couldn't afford the exploding payments on their risky loans, and were dumped into foreclosure by the millions, which flooded the market with desperate inventory and drove prices down even further in a vicious spiral. That doomsday machine simply doesn't exist today. Homeowners have equity instead of being underwater. They have fixed, affordable payments instead of ticking, adjustable ones. They have the financial cushion to ride out a dip instead of being forced to sell into it. So even where prices are softening now, there's no mechanism to turn a soft landing into a free fall. The selling we're seeing is voluntary and strategic, not forced and desperate, and that difference is everything. Voluntary sellers stop selling when prices get too low. Desperate ones can't. That's the entire difference between a rebalancing and a crash. So let's talk about that. What is actually coming next? Here's what the data and the major forecasters are pointing to. The single most important thing to understand is that nearly every major housing authority, including the National Association of Realtors, Zillow, Fannie Mae, and JP Morgan, is forecasting a market that's slowing but not collapsing. They don't all agree on the exact number, but they cluster in the same zone. Most expect home prices nationally to keep growing, just slowly, somewhere in the range of about 1 to 4% for 2026, with similar modest growth expected into 2027. That's not a crash. That's a market downshifting from a sprint to a walk. National price growth had already cooled to a crawl, around 0.5% year over year in early 2026, with about 13 states actually seeing declines, concentrated in those oversupplied Sunbelt markets we talked about. So the pain is real, but it's regional, not national. And it's a cooling, not a cratering. Now here's the part that genuinely surprises people. While prices cool, sales are expected to jump. The National Association of Realtors is forecasting roughly a 14% increase in home sales for 2026 after 3 sluggish years. Why? Because 2 things are finally lining up. Inventory is rising, giving buyers actual choices, and mortgage rates are expected to drift down towards 6%. That combination is projected to bring an estimated 5.5 million additional qualified buyers back into the market, including roughly 1.6 million renters who could finally become owners.
And Charlotte topped the list. Zillow says buyers see more homes within budget, less competition for each home, and forecasted appreciation, pointing to long-term financial gain.
And there's more room for negotiations right now.
Realtor Justin Brooks says while it's a buyer's market now, with mortgage rates expected to drop closer to 6% later this year, that could lead to a shift.
You want to get in now, you have room to negotiate with sellers, you have room to get credits.
So the very wave of selling that feels scary right now is exactly what's creating the opening for a new wave of buyers to step in. There's a measurable way to see this shift, and it's worth understanding. Analysts track something called months of inventory, which is basically how long it would take to sell every home on the market at the current pace. A low number means a seller's market with bidding wars. A high number means buyers are in control. During the pandemic frenzy, that figure dropped to well under a single month, the tightest in modern history. It's since climbed to its highest level in well over a decade, and several forecasts point to the national market tipping into genuine buyer's market territory somewhere between the middle of 2026 and the middle of 2027.
But their call is clearly that it's not a seller's market anymore, it's a more balanced market?
It is. It was a buyer's market because we were getting more inventory onto the market and prices were starting to ease, but it's starting to balance off a little more because there is that uncertainty in the market.
Many local markets, especially in the oversupplied Sunbelt, are already there. So if it feels like the ground has shifted under sellers, that's because, by the numbers, it has. But let me be honest about the other side too, because trust matters more than hype. Rates are not expected to crash back to those pandemic lows. Fannie Mae and others expect mortgage rates to stay near 6% or so, possibly into 2027 and beyond. This is a higher for longer world, and the affordability problems aren't vanishing. Insurance costs, property taxes, and the sheer price of homes are still going to squeeze a lot of people. So what's coming next isn't a boom, and it isn't a bust. By all the major forecasts, the most likely path is a normalization, a slow return to a more balanced, healthier, more predictable market over the next couple of years, with modest price growth, gradually improving inventory, and stubborn affordability challenges that don't disappear overnight. So now let me pull this all the way together, because the real story isn't the dumping, it's what the dumping is actually doing. Step back and look at the whole board. The investors are selling because the easy money is gone. The Sunbelt is correcting because it overheated. Owners are being squeezed out by carrying costs. And underneath all of it, a structural housing shortage and an equity-rich qualified pool of homeowners is keeping the whole thing from collapsing. Put those forces together and you don't get a crash. You get a great rebalancing. The market is letting air out of the most overinflated places, transferring homes from speculators back toward people who actually want to live in them, and slowly tilting power back toward buyers who've been locked out for years. In a strange way, this is the housing market healing, not breaking. A market where 1 in 4 listings comes from a hedge fund was never healthy to begin with. A market where homes flow back to families is. And that reframes the entire emotional picture, doesn't it? Because if you're a homeowner who isn't being forced to sell, the answer is simple. Don't panic. A paper dip in an oversupplied market is not a loss unless you sell into it, and the long-term floor under your home is stronger than the headlines suggest. If you're a buyer or a renter, this is the most important thing I can tell you. This moment, this messy, scary-looking wave of selling, is quietly handing you the leverage and the choices you haven't had in years. More inventory, motivated sellers, price cuts, and rates that may finally ease. The window that was slammed shut is creaking open. Because here's the lesson underneath all of it, the one I really want you to carry away. In housing, the crowd always feels the emotion of a moment, but misses the mechanics of it. The crowd sees for sale signs and feels fear. The people who actually build wealth see the same signs and ask why, who, and what it means. They understood that the smart money selling wasn't a prophecy of doom, it was a rotation. They understood the difference between a market dumping out speculation and a market collapsing, and they positioned themselves to catch what the panicked sellers were letting go of. The dumping you're watching right now is not the end of the housing market. It's the market changing hands from the people who treated it as a casino chip back toward the people who'll treat it as a home. The only question that matters is which side of that handoff you decide to be on. So don't let the noise make the decision for you. Look at your own situation, your own local market, your own numbers. Figure out whether you're a holder who should sit tight or a buyer who should start getting ready, because the opening may not last as long as you think once rates ease and those 5 million buyers come rushing back. The people who win the next 2 years won't be the ones who panicked at the for sale signs. They'll be the ones who understood what those signs were really saying. If this cut through the noise for you, do me one quick favor and subscribe to Bricks Market. This is exactly what we do here, separate the fear from the facts, and show you how the housing market really works, so you can make calm, informed moves while everyone around you is reacting to headlines. Hit that subscribe button, and I'll see you in the next one.